Debunking the derivative myth, why the Nairobi Securities Exchange is banking on this instrument to drive future growth. Good evening, many thanks for joining us. This is the Trading Bell. You know for sure that we are coming to you from the trading floor of the Nairobi Securities Exchange. Edwin Chui is a senior market analyst at Diane Blair. He will be joining us later on to help us understand how the market has behaved. But for now, we talk to Terry Adembesa. He's the director in charge of derivatives at the Nairobi Securities Exchange, so that he can help us understand where this market is going and when we are likely to see this market being introduced into the local markets. Let's now talk to Terry. Hey, Adembesa.
Yes.
It's nice to meet you.
Nice to meet you, Brian.
Hey. Yes.
Thank you.
Yeah. So, derivatives, we're talking about them this evening.
Yes.
Such a big word, huh? What exactly do they mean?
Well, derivatives are not, maybe in a financial sense, it will sound like a heavy word, but you know, a derivative is just something derived from something else. Yogurt is a derivative of milk, right? So it shouldn't be seen in complex, as a complex term. In the financial sector, then it might be considered complex, but purely it's, you know, from a lack of understanding what these products are. And in a nutshell, basically, it means it's a contract that, you know, is derived from another asset. Okay, for example, it could be an equity, a share, right? So you could have a derivative of a share.
You're even making it more complicated. A derivative of a share.
Yes.
What exactly is this? Can you give us an example? For example, can you break it down for us and give us an example?
Yeah. Think about it this way: if you needed to trade on a future price of an instrument, and you can't trade the instrument itself, okay? So you'd have to trade a contract of that instrument, okay? A good example would be, think as I like to use, think of maize, right? If you're going to trade on maize, you could either trade it now, which is the spot market, or you could trade it on a future date, assuming after harvest, and that would then be the forward or the futures contract on maize. You wouldn't trade the actual commodity, you trade a contract. So and the same applies for equities. So you can trade your share now, or you can trade a bond now, or you can trade on the future of that particular asset. And basically, the exchange between yourself and the other counterparty would be a contract.
A contract.
Yeah.
In the oil industry, we know of hedging.
Okay.
Whereby you can hedge the price of oil,
Yeah.
you know, for the next 6 months or even 2 years.
Yeah.
Is it different from can we also say this is also another hedging of shares or assets?
So corporates that hedge on the oil contracts are basically participating in a derivative contract, an oil derivative contract. Okay? So, you know, think about it this way. They require, you know, to be assured of their supply of oil for
a period of time.
For a period of time. So, and because of the nature of their business, any volatility in oil prices would greatly impact their business. And so what they would then do is trade on a contract based on a future, based on the, you know, coming months, and try and fix the price of that contract, and, you know, with their counterparty, and say, we are going to buy oil from you at a certain price. Okay? What it does, it gives them surety that, you know, I have, you know, say in September, I'll require X barrels of oil. Dependent on what the price of oil is then, I've already fixed my price. I am assured I can project what I will spend for my oil consumption, for my oil purchase on that particular time. And that's what corporates try and do. And it's not fundamentally different from what another corporate would do if they required, say, foreign currency. They know they have some obligations that they need to settle in the future that require them to settle in a foreign currency. Yeah. And so you see, instead of waiting until that particular time, it's possible for them now to get into a contract that fixes the kind of the rate that they want to be able to buy the foreign currency at that particular time that they have to settle that obligation. Yeah.
And so who is eligible to trade in derivatives? Everyone
is open. You know, the market is open for everyone. It depends on different investors have different requirements for using such instruments. You have, you know, like these corporates that need to hedge, right? Because they want to remove that price volatility on the underlying security that they require. So they participate because they want to hedge. You have investors who want to participate because they want to protect their existing portfolios. So if you're holding a basket, a portfolio of stocks, and you think that the price is going to go down, right? And you don't want to necessarily sell off your stocks, then it is possible that you can buy a derivative contract that will enable you to hedge out the price during that period without necessarily having to sell the underlying securities that you're holding. So different people have different, are motivated by different reasons to participate in the market.
I mean, from the way you're actually defining it, it's not as easy as a lemon squeezy, but could this be the reason why, I mean, it has taken 5 years, because we've been discussing introducing the derivatives market, you know, for the last 5 years. Yeah. Could this be the reason why probably maybe it is taking too long, you know, for the approving authorities, you know, to give the nod?
Generally, when you're introducing a new thing like what we're trying to do as an exchange, it is important that we carry everyone along, okay? And you know, we as an exchange touch on very many stakeholders, from the regulators, from the investors themselves, both foreign and local, institutional and retail. There are other market players who are also concerned on what we are doing. So, you know, carrying everyone along, making sure everyone is aware, making sure that everyone understands what this new market entails, would ideally take some time. And that's what we've been doing. We've been spending some time with the regulators, we've been spending time with investors, with market players, to get them up to speed so that, you know, when you finally switch on, we have good uptake.
Very well. And is the Kenyan market ready for a derivative market, bearing in mind that in Africa we only have South Africa with this kind of instrument?
It depends on the category of then the investors and where they are at. For example, we've just spoken about local corporates that participate in foreign markets to hedge out, to buy, you know, hedging instruments for their various, you know, commodities, for example, oil. Or some corporates, we know, local corporates that, you know, have foreign exposure risks on their books that they would require such instruments for their business. We know that they are looking at the cash markets, the equities cash markets currently, that historically they've been one directional, meaning if everyone is buying, everyone is buying. If everyone is selling, everyone is selling. And what that does, it creates a challenge that, you know, if you wanted to participate on the opposite side, it might not be possible, maybe for lack of the inventory or the securities. You might want to buy and no one is selling in the market. That's really a fact of what we call liquidity. So as our markets are growing, there's a concern on liquidity, and investors who then are unable to access the underlying stock but want to get exposure into the particular stock or index would then participate through a derivative instrument. Yeah.
But, it's fair to say that this is a very complicated kind of an instrument that requires a certain level of expertise and knowledge. So how are you going to ensure that once this market is introduced, that the public is aware of what how to trade in them and how to maximize on their benefits?
So there are a number of things that the exchange is doing. One of them is to get the market players, who are the ones who face the clients, to understand fully what is entailed as so far as the trading, settlement, and clearing of these instruments are, right? So if your stockbroker or your investment bank or your bank understands, your relationship manager understands what these products are, then it is possible that you as an investor can then walk up to them and say you want to participate in this particular asset class. So that's what we're doing. We've been spending quite a bit of time with market players to get them ready. And then after that, we will then now roll out a campaign targeted at the wider public to now educate them on what derivatives are, how can you participate in this instrument, what are the possibilities you should expect while you participate in these instruments, and who are the people, who are the players you need to talk to in case you want to participate. Yeah.
And Adembesa, I know you've been talking to the market regulators. Have they given an indication as to when they're likely to give a nod to the rollout of the derivative market?
We are working closely with the regulators, very closely and collaboratively. And our intention is that before the close of a year, that we should be able to initially do a soft launch. Would like to start the market in a controlled environment first before we open it up to the general public. Yes.
Terry, thank you very much indeed for joining us here.
Thank you very much.
Appreciate it.
Thanks.
Terry Adembesa is the director in charge of derivatives here at the exchange, helping us to break this tough nut called the derivative market. This is the Trading Bell. Stay right here. There you have the figures of how the market traded in the last 1 week. Edwin Chui is a senior market analyst at Dyer & Blair, joining us here. Now, it's a very interesting scenario here whereby you have the market appreciating, and bearing in mind that we are getting closer and closer to the election where the opposite would be expected. Why is this the case?
The main explanation is that our local institutional investors have actually come back into the market. They have been out of the market for a bit now. The better explanation is that valuations are still low, so it makes sense to come into the market. And we do expect the market to really pick up after the election. So if you're coming in now, you're coming in at the right time. Yeah.
And why do you think they are coming at this time, bearing in mind that sometimes around November, December, the market had bottomed out and the valuation was heavily depressed?
The not so politically correct answer is that we need a revolution in the fund management space. If you ask people like me, they will tell you that they should have come in not just in November, but even in January last year. but they didn't come in at the time because two reasons. One, I would argue that the trustees who make these decisions are probably not as risk-loving as I would want them to be. But then I would also argue that once you go through a bear run for over 2 years, then it's more likely that your degree of risk aversion goes up. So those are the two reasons why they took time to come in.
Mm-hmm.
Yep.
And when you look at the top gainers, we have Mumia Sugar Company. They are appreciating the most by about 20%. And bearing in mind that it has been the news for some not so good news, why is this the case?
Two probable reasons. Number one, people are closing the book. But then on the other side, there are people speculating on the stock. There's really nothing fundamental. As you've mentioned, the company has been in the news for all the wrong reasons. So nothing really positive to drive the prices up, other than speculation on the one hand and people who want to close the book on the other hand. Yeah.
And on the top losers, Home Africa, Kakuzi, Marshalls, Uchumi, Express Kenya, are there shockers here?
They're not shockers there. I would say those stocks, I wouldn't expect them to be doing well. Because if you're going to be going into the market right now, there are many other better options. Yeah.
And of course, you know for sure the whole of this week we've been talking about the derivative market, which the stock market plans to introduce, and they are waiting regulatory approvals. Kindly take us through the process of trading in derivatives.
Well, the process is relatively similar to how you trade anything else in this market, in the sense that you need to, of course, go to a broker, you need to have a CDS account, and then you need to have a conversation with the broker with respect to what the margin is, how much money you actually need to put in. I'm not sure whether that has been decided as yet, but the broker is in the best position to tell a client how much money they need to put in. Yeah.
And is this market cut for everybody, or are these instruments cut for everybody, or they are for sophisticated investors?
I'm inclined to say they are for sophisticated investors who understand the complexities of the instrument. But I believe that derivatives are all for all. So as long as you understand why you're going into them, maybe for hedging purposes, maybe for speculation, anyone can go into them.
So for retailers as well as institutional investors, both can trade in derivatives.
Yeah.
Are you optimistic on looking forward for this kind of a market to be introduced to Kenya?
I think there is definitely room for it. And I think there are definitely enough people who understand how that market would work. So yeah, I'm optimistic.
And how do you expect it to change the market?
It definitely will make the market a bit more vibrant. We are not going to be having the kind of conversation we are having now, that the prices are too low and there is no activity for so long. So it definitely is going to create a bit of vibrancy in the market, which is good for everybody, I would say.
Very well.
Yeah.
Thank you very much, Edwin, for joining us here. Edwin Chui is a senior market analyst joining us here to help us understand more about the market and how the market has traded in the last 1 week. This is the Trading Pal.
Thank you, Wainoe Mwangi, for your question. A derivative is simply an asset whose value is based on the value of an underlying asset. So its value is derived from another underlying asset. An underlying asset could be a stock, it could be an index, it could be a commodity or a bond. A very simple example would be a yogurt is a derivative of milk, meaning that the value of yogurt is based on the value of milk.
historical perspective of how the market has evolved in the last 50 years or so. Well, that brings us to the end of the Trading Bell for today. Many thanks indeed for joining us. We look forward for the same company next week right here on KBC Channel 1. Our communication channels are open and ready for you. Our Facebook page is the Trading Bell TV show. At the Trading Bell is our Twitter page, and the Trading Bell is our Instagram page. Our SMS line is 22162, and of course remember to start with the word BIZ, that is B-I-Z. My Twitter handle is at O'Brien Kimani. Now we take you back to Broadcasting House for the continuation of Business Insight. From me and the rest of the Trading Bell team, have yourself a good night.